Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Russ Kinnell examines previous bear markets to figure out the best defense. Christine Benz shares the must-have documents for estate planning. Alec Lucas surveys the dividend landscape. Christine Benz offers advice for creating income when yields are low and provides a personal finance to-do list. Let's get started. Here are Christine Benz of Morningstar Inc. and Russ Kinnell from Morningstar Research Services.
Hi, I'm Christine Benz for Morningstar.com. Stocks have recovered nicely of late, but some investors might be looking at their portfolios wondering if they're in position to play adequate defense for what comes next. Joining me to share some research on that topic is Russ Kinnell. He's Director of Manager Research and Editor of Morningstar Fund Investor. Russ, thank you so much for being here.
Glad to be here.
Russ, you recently did some research where you looked out over the past three bear markets and you looked at how a total stock market index fund would have performed relative to Vanguard Balanced Index over those three bear markets. What did you find there?
I was simply interested in what kind of defense you get from going from a pure equity exposure to balanced. And I found that if you just using as a proxy Vanguard Balanced Index versus Vanguard Total Stock Market, and there I found Vanguard Balanced Index had about half the losses from peak to trough as a total market. This current market wasn't quite as good, about 35% loss for the total market versus about 23% loss for the Balanced Index, which is a 60/40 S&P 500 and aggregate bond index combination. So, significant improvement and diminishment of losses just by going with a plain old 60/40 mix.
And of course, the Balanced Index has a very high quality, very plain vanilla fixed income piece. That helped as well, right?
That's right. That's really crucial in a bear market, or at least it has been in the past three, because treasuries benefit from that flight to quality, whereas a lot of other bond portfolios with maybe a little more credit risk don't hold up as well, because of course people are worried that those lower quality credits won't be able to actually make good on their payments.
You also took a look at a total market index, a U.S. market index, Vanguard Total Market Index, relative to an international index fund. I wouldn't expect that you found that the international index fund held up necessarily relative to the U.S. index. Did it over the three bear markets that you examined?
Not really. You're correct. So in the 2000 to 02 bear market and the 07 to 09 bear market, international did worse. In this current one this year, it did slightly better. But obviously that kind of prompts the question, well, what good is international if it's not really going to reduce my losses? Where's the diversification? And I think particularly in a panic and an extreme sell-off, the markets tend to all go in lockstep, and certainly you see that. But where I think the diversification exists is a little more like diversifying between small and large cap, or having healthcare and tech and financials in your portfolio. It's more that there are time periods where the performance can be very different. So if you look at, say, various 10-year cycles, there are times when international did much better than the US and vice versa. So I think it's that kind of diversification you're getting. It's not the kind that, say, you get from having treasuries that are ballast in a bear market, but it's still a meaningful adder of diversification.
How about value versus growth? Did you see any differential in bear market performance there?
So we did see sharp differences between those two camps in that first bear market. As you may recall, 2002, growth got crushed, lost about 51%. And of course, a lot of active growth funds did even worse. Value held up much better, 38% loss. But over the two ones after that, value did much worse than growth. So again, another case for diversification. It's really hard to predict those things, but I think the reason you see those differences is that bear markets tend to hit one or two sectors extremely hard, and therefore that tends to be either growth or value gets hit harder. And in this current case, of course, it's about being economically sensitive, and those areas which are in the value camp got hit hardest. In the 2000 bear market, it was much more about valuation compression because there had been such a huge speculative boom on the growth side. So you really see there can be very stark differences between value and growth.
Did you find any category or asset class that performed well and had positive returns in all three bear periods?
Only treasuries. Long-term treasuries did particularly well, but even short-term treasuries did well. Some of the short-term muni indexes and funds had positive returns in the prior two bear markets, but they actually lost money in the current one, admittedly a small amount. But it makes a lot of sense because there's such a tremendous burden on states in this current environment, as well as tremendous recession, that has a lot of people worried about our states, our cities, and other municipal issuers going to be able to make their payments. And so it just shows even high quality munis are not impervious.
And high yield bonds, predictably poor, I would imagine?
Exactly. In 8 years out of 9, high yield is so much better than government bonds or even high quality bonds because, as the name says, they have high yield, but they do a lot worse in these bear markets. That's the price you pay. In all three of them, we saw high yield losing over 20% from peak to trough. So that's a meaningful hit, and it's just a good reminder to everyone that high yield behaves very much like a hybrid of equities and bonds, because a lot they come from equity holders, but they come from corporate issuers, but also they come from highly indebted corporate issuers. So in the end, the results of high yield are not so different from that 60-40 Vanguard balanced index fund.
Okay, Russ, it's always great to get your insights. I'll look forward to reading the full research in Morningstar Fund Investor. Thank you so much for being here.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa. Now, Susan Jabinski and Christine Benz of Morningstar Inc. share the must-have documents for estate planning.
Hi, I'm Susan Jabinski with Morningstar. Creating or updating our estate plans very often falls to the bottom of the to-do list. However, Morningstar's Director of Personal Finance, Christine Benz, suggests that we use this crisis as a reason to look at our documents and make sure everything is in place that we need. Today, we're going to talk about a few key issues that should be top of mind. Christine, thank you for joining us today.
Susan, it's great to be here.
Now, the current crisis that we're in the midst of is first and foremost a healthcare crisis. So maybe we should start there. What are some important healthcare documents that we should have in place as part of our estate plans?
Absolutely. So at the top of the list would be naming someone to serve as power of attorney for health care. And the basic idea is that you're entrusting someone you trust to make health care decisions on your behalf if you're unable to do so. So everyone needs power of attorney for health care, regardless of your financial circumstances, regardless of your level of wealth. It's absolutely crucial that you legally document who you want to make these decisions on your behalf. It's also worthwhile for everyone to have what's called a living will. And the idea there is that you are spelling out your attitudes to healthcare, to life-extending healthcare. So you should have that living will. You should share it with the person who is your power of attorney for healthcare to make sure that he or she is aware of your attitudes toward life-extending care.
Now let's pivot over to the financial side of things. What are some of the documents that are essential there?
Well, here again, power of attorney is important, and you have two powers of attorney, one for healthcare, one for financial matters. And they don't need to be the same person, but your delegating responsibility for carrying out your financial affairs to someone if you're unable to do so. So those are absolutely crucial. Having wills is also important, where you are laying out what you would like to happen to your assets and your other possessions if something should happen to you. And finally, beneficiary designations tend to be really underrated when it comes to estate planning. Many people don't recognize that even if they've gone to the trouble of creating expensive estate plans with the help of attorneys, the estate plans are oftentimes overridden by what they have laid out in their beneficiary designations. So it's absolutely crucial to take a look periodically at your beneficiary designations. I recommend a once yearly review of those. Sometimes if you've changed investment providers, they might not necessarily have poured it over, or perhaps you've had a change in your own family situation where the person you wanted to be your beneficiary in the past might not be appropriate anymore. So make sure that you're periodically revisiting those designations and keeping them up to date. They're super important.
And what about parents who have minor children?
Absolutely crucial. So you want to make sure that you have named guardians for those minor children, and make sure that your guardians are aware of your thoughts. Make sure that they're comfortable with the potential obligations that could come along with the honorific of being named a guardian. Another thing that I think about, Susan, and this might seem kind of small in the scheme of things, but to pet owners who have animals in their lives, I think you want to think through who would serve as caregivers for those animals if, for whatever reason, you were unable to take care of them, either short-term or long-term. I think it's wise to line up who would be the guardians for any pets in your life.
And what about trusts, Christine? Who needs them these days?
Well, 15, 20 years ago, trusts were sort of a standard prescription for even moderately affluent couples, especially. They would set up these AB or bypass trusts. Now the estate tax exclusion is really high. It's over $11 million per person. That means that married couples would need to have $23 million in assets together to be subject to the estate tax. But nonetheless, I think that parents of minor children in some cases may want to investigate trusts, particularly given that the Secure Act, which passed through Congress in late 2019, did away with what's called the stretch IRA. So it's something to investigate if you're sitting down with an estate planning attorney to talk about firming up the rest of your documents. You might ask whether a trust might be appropriate for your situation. Certainly for people with special needs, individuals in their lives, they too may investigate whether a trust may be appropriate. Very often that is the right answer for families with special needs children.
Lastly, Christine, you think that now is also a good time for us to look at some of our non-legal financial documents. What do you mean by that?
Right. As you know, Susan, we've talked about this idea of having a master directory, and the basic idea is that you're creating a spreadsheet or some document like that where really you're outlining your major financial relationships. So the brokerage firms and mutual fund companies that you have accounts at, what your account numbers are, any individuals you deal with at these institutions. Lay that out in a document. You want to keep it very secure because, of course, this is information that could be very valuable in case of identity theft or some other situation like that. So if it's an electronic document, you want to go to the trouble of password protecting it or encrypting it. If it's a physical document, you certainly want to keep it under lock and key. And then from a practical standpoint, I created one of these master directories, and I also created a little bit of a narrative along the lines of I have these 4 accounts, and just to sort of spell out the basic framework of our financial plan, just because that master directory might be just a little bit difficult to get your head around as a standalone element. I think having a little bit of a narrative discussion can also be helpful if you have the time to go to the extra trouble.
Well, Christine, thank you for your time today and for helping elevate this further up on our to-do lists than maybe it's been, and giving us the direction that we should take with it. We appreciate it.
Thank you so much, Susan.
For Morningstar.com, I'm Susan Jabinski. Thank you for tuning in.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Tom Lauricella of Morningstar Inc. interviews Alec Lucas from Morningstar Research Services.
I'm Tom Lauricella from Morningstar. And today, I'm joined by Alec Lucas, and we're going to discuss the landscape for dividend investing. Alec, thanks for joining us today.
Thanks for having me.
So there's been a lot going on when it comes to dividend investing, investing for yield in general. We've had a big drop in interest rates. We've had a big hit to the economy, which flows through to companies' abilities to pay dividends. Why don't you give us an overview of what the landscape looks like for an investor trying to invest for yield?
Yeah, income has become hard to come by. That was true before the coronavirus closures happened here in early 2020, and it's especially true after. So to give context, the 10-year Treasuries yield, which had been above 3% briefly in years past, since April, it's been around 60 basis points to about 80 basis points or so. So around all-time lows, and it's not going to beat the historic inflation rate of about 2.2%. Corporate bonds could edge the cost of living. The Bloomberg Barclays U.S. Corporate Bond Index had a 2.7% yield to maturity as of April 30. But the problem with bonds, of course, is that their prices could fall if yields rise. And so there's also some default risk with that, too. So dividend-paying stocks, on first blush, don't seem so attractive because there have been a number of dividend cuts. By my count, from late February through mid-May or so, 240 companies in the U.S., at least 240 companies have cut their dividends or canceled buyback plans or suspended their dividends. At least one of those things. But if you look at the comparison between the projected one-year dividend yield on the S&P 500 versus a 10-year Treasury, stocks look historically attractive relative to the yield on bonds right now. So if you can invest smartly in dividend-paying stocks, that is a way forward. And of course, with dividend-paying stocks, you have the benefit and potential for price appreciation as well as the dividend raising, the payout increasing over time. And of course, you are taking on additional volatility when you invest in equities versus bonds. But if that's done well, it can be something that's additive to a portfolio.
So investors looking for yield right now, it appears that stocks offer the potential for better returns. But of course, there's different ways to come about that. And you mentioned that dividend growth is one aspect of this. But for some investors, they may just simply be out there looking for just whatever the highest yielding stocks there are. Given this environment, what probably makes more sense in terms of investing for dividend growth or investing for simply for yield?
Yeah, I think if you're going to pursue income through equities, you have to have in mind two categories of companies or strategies, rather, that you invest in. One is high dividend yield strategies. They tend to invest in mature companies that are very cash generative and pay out a large portion of their earnings to shareholders. And that results in a high yield. So we're thinking, in this environment, 3% would be pretty substantial, even 4%. But you want to be careful that you don't invest in companies that are offering such an attractive yield that it signals that the company's prospects for growth might be distressed. So if you see something in the neighborhood of 7% or higher, that's an indication to investors that that yield might soon disappear. In contrast to high dividend yield strategies are dividend growth strategies. And in this case, the companies tend to be a bit younger, they tend to have more growth, and they're paying out a lower percentage of their earnings. And so the yield itself is smaller. So think around 1.5% or so, but they're growing their payout steadily. And of course, if the share price is increasing, then the yield may actually go down even as the payout goes up. And that's, of course, a good problem for investors to have. Those kinds of companies have shown more resilience typically than high dividend yielding stocks, and they've been less prone to cut their dividends. And that's certainly the case in this recent coronavirus environment.
And you mentioned some of the data that you've looked at in terms of the number of dividend cuts that we've seen. Can you go into a little more detail in terms of where we've seen those dividend cuts? What types of companies have they tended to be on? How broad-based has this been? It's a big number, but where is it concentrated?
So dividend cuts have been fairly widespread, but that doesn't mean that certain parts of the market haven't been hurt more than others. But to speak to the widespread nature of dividend cuts, there have been at least 240 U.S. firms that have cut their dividend, suspended their dividend, and or canceled buyback plans. And that's been 68 out of 142 Morningstar industries have been affected. But the industries that have been most affected tend to fall within the energy space. So oil, gas, and exploration companies lead the way, followed by oil and gas midstream companies. That's probably not surprising given investors who've been following the energy space, given that there's been a challenge both from demand as well as an oversupply. So that's put a special pressure on energy, which was challenged even entering the year. Real estate investment trusts have cut their dividends, obviously with questions about companies leasing office space and so forth. That's been a headwind for them and a major one and led to a lot of dividend cuts. Some noteworthy places where you've seen dividend cuts that perhaps you might not expect. Regional banks have cut their dividends. Asset managers have tended to cut their dividends, smaller ones. And obviously airlines and restaurants and retail, you've seen dividend cuts there as well. If you look at the whole universe of companies that have cut their dividends, certain themes emerge. One of them is that they tend to be smaller companies. So out of those 240 companies that cut their dividends, the median market cap was 1.1 billion. So that's a small cap company for the most part. And of course, you have to take into effect that their market caps have shrunk. Obviously, with the market turmoil and the cut of the dividend, that would have naturally shrunk the market cap. But even taking that into account, these are smaller companies. Bigger companies, though, haven't been entirely unaffected. So there's 220 stocks in Morningstar's U.S. large cap index, and 21 of those companies cut or suspended their dividend and or canceled buyback plans. And so some prominent companies that are in that index that you've heard about in the news, Boeing would be one, Schlumberger, Occidental Petroleum, Southern Copper, but even a stalwart like McDonald's or 3M have canceled buyback plans. So companies obviously are being conservative, and this is in contrast to what we've seen in the market. The market has had a pretty significant rebound since its March 23rd low. In fact, April, the rally in April, depending on the index you look at, was one of the strongest we've had in a long time. And yet April was also a month in which we saw an acceleration of dividend cuts. So I think investors have to be cautious when going to equities for yield, and they have to play it smartly. And again, I would suggest that the way to do that is to keep in mind the difference between high dividend yielding companies, and you don't want a dividend that is so high that it's prone to being cut because the market is signaling that. And again, that's in a yield of 7% or more. You'd have to be especially cautious on that. And a small yield might be unattractive in the present, but that's the kind of thing where the payout might grow given the company.
So what are we seeing in terms of how mutual fund managers that oversee dividend strategies, how are they faring? How are they navigating this? What are we seeing from, for example, some of the Morningstar medalist dividend funds?
So with all the dividend cuts, you would expect that income-oriented funds have been hit the hardest. And certainly we've seen some strategies hold companies that have cut their dividends. So Royal Dutch Shell is a holding in a number of funds that it's a company that cut its dividend. But in general, active managers who have income-oriented strategies are very used to thinking about potential dividend cuts and trying to steer away from companies where they're worried about that. And so we've seen an impact, but not perhaps as dramatic as you would expect. An example would be American Fund's Income Fund of America, which strives for an above average dividend payout and invests in stocks, but also bonds as well. Its March 2020 portfolio, just 2.3% of its assets were in companies that cut their dividends. And about half of the stocks in that portfolio had already cut their dividends, and another half would go on to do so. Where we have seen strategies most affected by dividend cuts are deep value strategies. So LSV, which has a small cap value strategy, as well as sub-advises a mid cap value strategy, they've held double-digit stakes in companies that have cut their dividends. But these kinds of companies are, again, smaller. So we're thinking about small cap REITs, the kinds of things that a lot of the largest active funds just aren't investing in. But they've held because they tend to have a contrarian streak. And I would clarify that just because a manager holds a company that cut its dividend doesn't actually automatically trigger a sale. So a good example of this is T. Rowe Price Equity Income. Its manager, John Linehan, takes into account total yield when he makes investments, so dividend plus share buybacks. And he's reticent about selling a stock if he sees a path for recovery. And so a good example of that is if you compare his year-end 2019 portfolio with his March 2020 portfolio. He had airline exposure at the end of 2019, but continued to have it in March of 2020. He did sell a position in Southwest as well as Delta, but Alaska Air, he actually added to Alaska Air Group, his position in Alaska Air Group, modestly so, but added exposure amid the cut.
All right, great. That's a lot of fantastic information. Alec, thank you very much for being here today.
Thanks for having me.
Now, Christine Benz from Morningstar Inc. offers advice for creating income when yields are low.
Now I want to address a question I've been getting a lot from people who are already retired. And that is, how do you create a livable income stream from a portfolio in an era in which yields are really, really low today? So it's definitely a conundrum. And first, I want to talk about why this is happening. And there are a couple of big reasons. One is policy. So the Federal Reserve has its interest rate policy that it sets, and in an effort to stoke the economy and get people out there borrowing, it has pushed its target interest rate down near zero. So that's one reason. And then another key reason is that people have been gravitating to very safe investments. And the net effect of that is that it pushes up the prices of safer investments, but it also pushes down their yields. So this has made life really difficult for people who are retired and who had hoped to subsist, at least in part, on whatever income their portfolios throw off. So a couple of pieces of advice for people in this situation. First, I wouldn't expect it to get better overnight. There are a lot of headwinds facing the economy. I would expect that interest rates would stay down for a good long while here. And the fact is, we have had a secular period of low interest rates. So it's something we've been living through for a while, but it has also gotten progressively worse over the past several years. I would also caution against really chasing things that have much more attractive yields than you can find on safer investments today. So given that we have seen some volatility in the market, we have seen yields rise on some types of investments. So junk bonds or low quality bonds have seen their yields pick up. Real estate investment trusts now have pretty nice yields attached to them. These securities might be part of your portfolio, but I think you want to be careful about trying to extract all of the income you need from your portfolio using very risky investments. In general, these investments are volatile and their fortunes tend to be really tied to what's going on in the economy and in the stock market. So when the economy is down and the stock market is down, the prices on these securities are often down as well. So be careful about just building a portfolio of high yielding investments. I think the best bet for retirees at this juncture is to take a step back and build a broadly diversified portfolio and bolt onto it a cash bucket that you can use for ongoing living expenses. In my work on Morningstar.com, I often talk a lot about this bucket strategy. And the basic idea is that I'm stepping back and thinking about how can I create a total return portfolio that is going to give me the best risk-adjusted return over my in-retirement time horizon, and then periodically prune from it whatever looks ripe for the picking. So maybe when yields get better, I'll be able to pull all of the income I need from yield-producing securities. In other environments, like in 2019, my best source of cash flow is the appreciated equity piece of my portfolio. So the virtue of having the cash bucket attached to the total return portfolio is that I can use that as kind of a buffer zone. If neither my income producing securities or my equity securities are performing particularly well. That's the basic setup that I talk about when I talk about building a bucket portfolio for retirement. And in the model portfolios that I've done along these lines, I've typically earmarked a couple of years worth of portfolio withdrawals in true cash investments. So no risk involved in these investments. I've just got 2 years worth of portfolio withdrawals parked in CDs and money market funds, maybe online savings accounts, not taking any risk with this portion of the portfolio. And then I'm stepping out on the risk spectrum a little bit from there. So in my model portfolios, I've thought about having 5 to 8 years worth of portfolio withdrawals in short and intermediate term high quality bonds. And the idea is that you're picking up a little bit more income and a little bit more volatility potential with this portion of the portfolio, but you're also protecting yourself a little bit from inflation. So you are giving yourself a little bit more return potential with this portion of the portfolio. So if you have that 2 years worth of cash and another 5 to 8 years worth of short-term and intermediate-term high-quality bonds, you've essentially built yourself a runway of, say, 7 to 10 years worth of living expenses in safer investments. That way, if stocks go down and stay down for a good long while, you could spend through those first two buckets before you would need to touch the stock bucket. So with this bucket strategy, you are holding any money that you would need for 10 years and beyond of retirement. You're holding that in stocks, but you're giving yourself enough of a buffer to ensure that you're not needing to touch stocks when they're down. So that's the basic bucket setup. I've done a lot of different versions of this on Morningstar.com, not so much with an eye toward beating any other retirement income strategy that's ever been devised, but really as a means of showing investors how to create a sane portfolio in an era in which income production is really pretty sparse.
Expand your investing horizons and look to the long view with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Susan Jabinsky and Christine Benz provide a personal finance to-do list.
Hi, I'm Susan Jabinsky with Morningstar.com. During the current COVID-19 crisis, some people are finding themselves at home with a little extra time on their hands. Joining me today to talk about some financial tasks you might consider knocking off your list while you're at home is Christine Benz. Christine is our Director of Personal Finance at Morningstar. Christine, thank you for joining me today.
Susan, it's great to be here.
Now, we'll first start by saying, of course, there are plenty of people right now who are busier than ever, so they don't necessarily have the time on their hands that we're suggesting. But if you are at home and you do, you're saving yourself a commuter, or for whatever reason you find you have some spare time, one financial task you suggest knocking off that list is doing your taxes. Now, we have until July, so why do you think that's something that should be on the top of our to-do list?
Well, obviously, if you're getting money back, you don't want to delay filing, get that return in as soon as possible to expedite your return. If you are owing, I still think it's worth figuring out what you owe. You'll ultimately wait until July to file your return because you don't want to have to pay any sooner than you need to. But take your time to figure out what you owe. And also, if you do owe maybe more than you expected, it'll give you some time to think about where you'll go for funds to pay your taxes and potentially budget for them in advance.
Now, you also think, Christine, that now is a good time for us to sort of go through our financial paperwork and get things organized.
Right. I've been banging this drum for a while, but in my experience, people hang on to way too many paper documents. It gives them filing headaches, and it also exposes them to more identity theft issues than would be the case if they were receiving electronic document delivery. So if your financial providers have been badgering you about going paperless, it's time to take them up on it. Check those boxes. You may even actually be paying to receive physical paper documents. So you could save a little bit of cash every month. And then once you've done that, go the extra step of culling the paperwork that you have hung on to. So go through your files. Chances are you're saving way more than you need to. I often see people save shareholder literature like annual reports and prospectuses. So you can get that stuff out of your filing cabinet and create a system that will be more skinnied down. And of course, you want to save any very difficult to replace documents in a safety deposit box outside of your house, ideally.
Now, related to do here, Christine, would be creating some of these documents, these larger overarching documents that we should have that address our investment and financial plans. What would those be?
Absolutely. So a few of the ones that I would call out would be what I call a master directory, also an investment policy statement and a retirement policy statement. So starting with the master directory, that's simply a guide to the investments that you own, where you own them, maybe the approximate account value, account number, and you want to password protect this document or encrypt it and share it with someone who could need access to your information in a pinch. So it's a way of inventorying all of your assets and having it in a streamlined sort of document that someone could take a look at if they needed to, if there were some sort of a financial emergency. An investment policy statement is another document that I think every household where you've got investors should have. And the basic idea is that it's a blueprint for your investment plan. So it lays out your asset allocation plan. It lays out your approach to reviewing your investments on an ongoing basis. So it documents how you will choose and monitor your investments on an ongoing basis. And finally, a retirement policy statement is something that I recommend that all retired households have. And the basic idea there is that it lays out your system for generating income in retirement. So it lays out your system for cash flows from your portfolio, what your withdrawal rate will be, how you will generate cash from your portfolio. You might include some details about your approach to Social Security and any other non-portfolio income sources as well. So those are really the big three documents that I think every household should have to document their financial and investment plans.
And lastly, one thing that often falls to the bottom of our to-do lists is creating or updating our estate plans. So what should we be thinking about there?
Right. This is one that seems to get pushed down to the bottom of everyone's list. And the fact is, it's not any fun to ponder our own mortality, but it has been top of mind recently as we've been monitoring the current crisis. So if you don't have an estate plan, you can either use some sort of an online resource, and there have been many that have popped up in recent years, or turn to an attorney. And I believe that many of them are now doing video conferencing. So you shouldn't use the current shelter-in-place rules as an excuse to put this off, because chances are you'll be able to find someone who will work with you. And so you're really looking to get the basics hammered out. You're looking to have a will. If you have minor children, you'd certainly want to have guardians specified for them. We all need to have powers of attorney, so people who will make financial and healthcare decisions on our behalf if we're unable to make them. A living will is another essential document to have. So check in with an attorney, or if you have a very simple sort of estate plan, you may use an online resource. But this is something to focus on, especially if you find yourself with a little bit of extra time. Another thing that I would add under that estate planning heading would be checking up on your beneficiary designations, because many of our assets do pass through beneficiary designations, and those actually supersede what you may lay out in your will. So definitely attend to those beneficiary designations. If you had an estate plan that made sense for you 10 years ago, there may have been some changes in your life. So check up on it to make sure that it still syncs up with your current situation.
Well, Christine, looks like you have a lot of smart and important things for us to do to fill our time that we have if we're at home these days, other than, streaming videos and watching movies.
Right.
So thank you for your time, Christine. It's always a pleasure to talk with you.
Thank you so much, Susan.
I'm Susan Jabinski for Morningstar. Thank you for tuning in.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.